Welcome, everyone. Welcome to Office Hours with Michael Kitces. So for today, I want to talk about this whole shift from actively managed mutual funds to passive funds. So it's no secret that flows to passive funds are on the rise. Actively managed funds just in the aggregate are contracting. So Wall Street Journal had an interesting article this week about basically the death of the stock picking business, where they noted, based on the Morningstar data, $1.3 trillion into passive vehicles over the past 3 years, and quarter of a trillion dollars, $250 billion, leaving actively managed funds over the past 3 years. So what that means, not only are we just buying passive with our new dollars, so the inflows to passive are much bigger than active, but we're now actually starting to proactively sell active funds to rotate into passive. So the net flows out of active are declining, while passive flows are like 5 times as large. Now, some have suggested this is being driven by just shifting consumer preferences for passive investments, given their lower cost. Others raised the question of whether this is basically about the rise of the AUM model, particularly amongst RIAs who don't have any financial incentive to sell actively managed mutual funds. So we're often just picking simpler, lower cost ETFs. I've even suggested in some of the past writing on the blog that I think part of the shift is actually that as investment costs compress, advisors are disintermediating fund managers and saying, I'm going to actually manage the portfolio myself to help justify my AUM fee. And since stock trading is too intensive, I'm going to use ETFs. I'm going to pull that fund manager out of the picture so I can save my client the fund manager's costs and have the client just pay me. So that's not really actually a shift to passive. It's a shift to where the active is occurring and the building blocks they're being used. But it's still driving flows to passive vehicles. And then last year, there was a good book that came out from Larry Swedroe and Andy Birkin called The Incredible Shrinking Alpha, suggesting that part of the reason that active management's on the decline is simply that as active managers get better, markets get more efficient, and there's actually less alpha on the table to go around. And so they're sort of suffering under their collective weight of crowding out their own successful alpha strategies. But, the reality is investment costs have been coming down for decades. It's not a new phenomenon of just the past 10 years. Markets have been getting more efficient for decades. There have been advisors trying to take money away from salespeople for decades. So none of that's actually new. And it raises to me the question of what is it that changed over the past 10 or 15 years that has made this suddenly the point over the past 100 years that actively managed funds would really begin to topple and indexing would begin to rise. And I think the real reason that actively managed funds are dying now is, to put it in one word, the internet. The internet did it. And here's why. So it's important to recognize how investment managers or investment performance were evaluated before the internet showed up. So for the average consumer, you only knew how you were doing about once a quarter, because a brokerage firm mailed you a statement. You open your mailbox, you pull out the statement, you open up the statement, and it told you your account balance, and you could see whether you were up. Maybe it helped you calculate how your investments were doing by giving you a statement with line items where each line item had the value and perhaps year-to-date performance. But it didn't compare to anything. So for most people, the only way they evaluated their investment performance was the one version of benchmarking that anybody can do easily in their head. Is it worth more now than it was last time I looked at my statement? Or at least, is it worth more now than it was when I bought it originally? And frankly, throughout the 1980s and 1990s, which was the rise of the active managed fund complex, well, the answer was virtually always yes. When you open your statement, you had more money than last statement because it was a raging bull market for 20 years. Now, those who wanted to monitor a little bit more closely could go one step further. The Wall Street Journal. So every day the Wall Street Journal had pages and pages showing prior day closing prices for most stocks and mutual funds, so you could see how you were doing. Again, though, it was just prices. So you could look up prices. If your prices were higher than the last time you looked in the newspaper, you were feeling pretty good. but no one really knew how to compare, right? If one large cap fund appreciated $4 from 39 to 43, and the second one was up $5 from 56 to 61, most people couldn't do the math in their head to figure out whether the first one was actually doing better than the second one, right? Because the second one was up $5 and the first one was up $4, but the second one has a larger price to begin with, and most people can't do the math in their head to figure out that the first one was actually only up 8.9%, the second one was up 10.3%. We can't do that math in our head. And so there was really no effective comparisons going on between funds to figure out whether they were actually doing a good job beyond just going up in value. And then the internet showed up. And when the internet showed up, it all changed, because for the first time, you weren't just looking up closing stock prices or the NAV of a fund to see if it was up. You could actually compare funds to one another with actual performance data. So we had, in the early days, platforms like Big Charts and ClearStation, and then Yahoo Finance showed up, and a whole bunch of others that would let you, for the first time, compare funds based on actual performance where someone did the real math. This was the same time Morningstar.com got going and turned what was originally kind of a small niche service, print service to investors who wanted to benchmark their investments, into a more widespread and easily accessible solution. And once we saw the data, we could learn for the first time that, frankly, a lot of actively managed funds kind of sucked. Not all of them, but a non-trivial number were not actually good performers. They were generating absolute positive returns, but they were terrible compared to others in their category, but we didn't know. We didn't know because we couldn't easily calculate performance. We had no tools to do it. We might miscategorize them, comparing small caps against large caps. So the rise of online tools, as well as, I think, supporting materials like the Morningstar Style Box, made it accessible for us to figure out what was actually a good fund and what was just a fund that was along for the ride and going up, but actually less than everything else in its category. And then on top of that, you could finally see costs in one consolidated place. Granted, they were there in a 172-page prospectus before, but now you could easily, in a central place, view the cost of all of your investment options. You could even screen on costs and just pick which ones you wanted. So basically, the internet made it possible for the first time for the average investor to easily do real performance benchmarking and cost analysis. And once that showed up, frankly, I think we're just watching market forces sort themselves out. Now, the second important thing about the impact of the internet on evaluating funds is not only was it possible to evaluate existing funds, but it was more accessible than ever to evaluate new ones. So it wasn't just about figuring out whether your current funds were making money but actually sucked because everything else was making more money in the same category. It was also about prospectively identifying where your money would go. Where, again, having tools that gave you transparent results about performance benchmarking and costs revealed how a lot of actively managed funds weren't actually better, and frankly, some were just being sold because a mutual fund person was being paid to sell them, sometimes under the guise of financial advice, but at the end of the day, the person was a mutual fund salesperson. So as the tools became available, suddenly consumers could directly screen good from bad funds. And the rise of online brokerage platforms, everything from Schwab.com to E-Trade, meant not only could consumers evaluate their funds, but they didn't have to pay a mutual fund salesperson, an intermediary, to buy them. So now they weren't being steered towards expensive funds that happen to have commissions. They could buy no-load funds that stripped out the distribution costs altogether. And thus we see the further rise of Vanguard, the rise of ETFs, the rise of fund solutions that have better performance because they're cheaper, and they're cheaper because they're not distributing through salespeople that need to get paid commissions. And with the internet and the tools and the technology, you can measure that for the first time. Now that's dragging through to advisors. Now we increasingly have to actually deliver real advice to earn our compensation, because just filling in mutual fund products isn't it anymore. But with DOL fiduciary rising coming next year, it's important to recognize this trend isn't changing anytime soon. In fact, I think it's going to accelerate because, frankly, once you unleash this technology transparency, it's almost impossible to close Pandora's box. But with DOL fiduciary, now advisors who actually call themselves advisors are going to be held accountable as advisors to recommend solutions that other prudent experts would recommend, because that's what a best interest standard is. Which means you can't sell a mediocrely overly expensive active fund just to get the commission You can't get just for the commission anymore. Before you could, as long as the underlying investment was at least suitable or not unsuitable to the investor's needs. But no fiduciary recommends a suboptimal bad performance mutual fund that happens to be suitable and pays a good commission. That doesn't work anymore. You can still have commissions under BICE, under the best interest contract exemption, but they still have to actually be good funds. And if the advisor fails to do the due diligence on that, now the advisor is liable. So the pressure is on across the board for everybody to use all these technology tools we have available to vet which funds are actually good using real cost analysis and real performance benchmarking. Now, that doesn't, I think, mean actively managed funds are completely dead, but I do suspect it means only a small subset of active funds that really demonstrate their value are going to survive. And the rest are basically doomed, at least in retirement accounts where DOL fiduciary duty applies. Now, the last notable thing about this trend where advisors have to recommend best interest solutions, and frankly, consumers are generally already in search of the best solutions, is that the combination of technology and transparency are still going to go a lot further in transforming markets. Because the truth is that this kind of transparency to analyze results and tools that make it easy to do so means the reality is only a minuscule subset of the best solutions are going to win. And the ones that do are going to win almost everything. Frankly, I think that's why Vanguard is so dominating the landscape already. Because the truth, especially when it comes down to ETFs, is that so many are commodity. I mean, when they all track the same index, you really actually don't need 100 or 10 or even 3 ETF options in that category. You need one. Whichever one that gives you the commoditized thing, the cheapest. That's how commodities work. You buy the cheapest one, and technology makes it easy to find the cheapest. This is why you're seeing an ETF price war erupt already between Vanguard and BlackRock and Fidelity and Schwab and all the other players that are getting in on it, because they know that the DOL fiduciary future means advisors have to do real due diligence. And when there's something as commoditized as an ETF for a popular index, the technology tools will make sure the best one always floats to the top, which means the future isn't just about being an asset manager that gets your fair share of the market. This is a winner-takes-all future. That's why the ETF price wars are getting so fierce right now, because truly, when you get down to a commoditized index, price is virtually the only differentiator, and the winner-takes-all market, you're either the cheapest or you get nothing. But again, the bottom line is just to recognize that all of this stems from, I think, really the appearance of the internet and the technology tools that made it possible for consumers and, frankly, advisors to be able to easily do real performance benchmarking and real cost analyses. You know, that's what changed benchmarking from open statements or look at Wall Street Journal page, is it worth more than it used to, into an actual benchmark comparison to available alternatives that revealed how many mediocre funds were out there, made it easier for consumers to buy cheap funds directly without paying salespeople, and unleash the whole trend. In fact, really, if you go back and look, you'll see that the rise of passive funds almost perfectly coincides with the internet showing up in the mid-1990s. Vanguard had been around 20 years already, but if you look at their growth, it starts going vertical in the mid-1990s because that's when the internet showed up, and suddenly you could buy this stuff directly without middlemen. Then the trend accelerated in 2000 because the truth is through the late 1990s, passive began to grow, but active was still growing because we were in a raging bull market and nobody really cared what performance benchmarking looked like when you were making money in, anything you threw a dart at in the Wall Street Journal stock pages. Once the bear market showed up and the market really began to turn, the truth was now investors actually cared. The combination of a bear market, availability of tools, was the beginning of the end of actively managed mutual funds. And from there, you're just watching the trend play out further. So I hope this is helpful. It's just some food for thought around the changing landscape, maybe an alternative narrative or way to look at why now seems to be the time that passive is so dominating active. This is Office Hours with Michael Kitces, 1 p.m. East Coast time on Tuesdays. Thanks for hanging out with us, everyone, and have a good day.